Okay, so let's have a look over here. So this is question. So this here is question 2 of Fact 4864. It's a past cycle exam, Cellular Connect. Okay, so if you, I think it was it's largely the same as a cycle exam, but it's slightly different. I think there's a few things that unis are kind of adapted. I can't remember. I looked at the cycle one last year or the year before, and I worked through it. I can't remember what's the difference, but we'll cover this one from a UNISA point of view. So you can see it's Cellular Connect. It is, like I said, the fact that they use a cell phone thing because it's one of the first detailed revenue questions that was set for the ITC exam. And when IFRS 15 first was brought about, one of the main industries impacted by IFRS 15 was the cell phone companies, because I think what they used to do in terms of IAS 18, they kind of just recognize a contract as one, or what they used to do, they would only separate the phone and then keep everything else together. So they either just recognize a contract as one, or they separate the phone and they keep all the other stuff together. But here with IFRS 15, IFRS 15 requires you to identify each separate performance obligation. So let's get going. So Cellular Connect is a South African telecommunications company listed in the wireless telecommunications sector on the JSE. Cellular was established in 2001 and listed in 2005. Cellular provides over 12 million customers with voice, messaging, and data services. Cellular is the third largest mobile network in South Africa. Okay, so probably Cell C, I don't know. So South Africa has one of the largest telecommunication markets on the African continent. The telecommunications industry is a capital-intensive industry which requires continuous investment in technology and infrastructure to ensure a reliable network that is technologically up-to-date and that has the capacity to deal with growth. There are approximately 80 million active cell phone activations in South Africa, a country with a population of about 53 million. The voice revenue in the South African cellular industry has been under pressure over the past 3 years due to limited growth in voice minutes and declining voice rates per minute. The major players have been reducing voice rates in response to competitive pressure. Changing customer needs and cheaper smartphones have resulted in significant growth in mobile data usage over the past few years, and this trend is expected to continue. Innovation in product offerings occur frequently in the industry. Rewarding loyalty by means of free data and minutes based on usage has also become very popular. Customer care remains an important differentiator between cellular networks, and as a result, network operators are playing more and more emphasis on customer experience, especially as competition becomes fiercer. Okay, so the initial paragraph over here, and then this over here, that is just basically background information. This is generally not so important for our purposes, for financial reporting purposes, but it can be important for a MAC question, because generally in a MAC question, or this can be important for an auditing question. So for a MAC question, typically strategy, risk management, and governance comes under MAC. Definitely strategy, risk management. Perhaps governance will fall under auditing, but basically this over here can be this point of view can easily be strategy, risk management, and governance. Okay, now remember with strategy, risk management, and governance, you'd either use PESTEL, Porters, or SWOT, right? So just take note of that. So if you know what's happening, what the mobile operators are doing now, because the cell phone industry is becoming now very saturated. A lot of people have already have cell phones, and a lot of people are picking up smartphones. So the market is becoming saturated. So what can they do? Is only way to other products, for example, like maybe like the watches and so forth, and perhaps soon now with the metaverse, they will start maybe having the sunglasses. Okay, we're gonna have like those sunglasses for the metaverse. But what are they currently doing to continue with their growth? Because they have such a large customer base, because they are so advanced in technology, because they have so much data. When I say data, they understand customer data, and they have the infrastructure, and they have the brand name. They're going into other services like financial services. That is why you'd see like Vodacom, MTN have payment services. Vodacom and MTN is same with FNB, entering into financial services, insurance, life cover, this, that, and the other. So that is basically how they kind of expand. FNB is also went into cell phones. FNB is going into also other types of financial services products. So that is basically, if you look at the strategy risk management question, just understand what our company is currently doing, and you will see Vodacom, they are big or going into fintech stuff. Okay, but it's not relevant for financial reporting. Okay, so let's have a look over here. So I think this is where the stuff starts, where things become interesting. So in 2016, in 20.16 financial year, Cellular had two types of customers, namely mobile contract customers and mobile prepaid customers. Mobile contract customers may choose between a number of different contracts, offering a variety of voice minutes, number of short messaging service messages, and units of data, depending on the specific package. Most mobile contracts include in-bundle voice calls, SMSs, and units of data. All voice calls, SMS messages, and units of data used outside of bundle are charged to customers over and above their monthly contract fee. All contracts are of 24 months duration, and customers receive handsets upon signing the contract. Okay, so here's important. So here they're giving you like details about the contract of a customer. Okay, so here you can see a contract. So they have two types of customers: mobile contract customers, prepaid customers. Contract customers there are different packages. So generally a package will include those in-bundle services, voice, data, and SMSs, together with a phone. They have to sign a contract, and a contract is 24 months. If we have outside of the, if people use voice call, SMSs, and data outside of the bundle, they will have to pay extra. So from IFRS 15 point of view, this extra payment outside of a bundle is known as a variable payment. Why is it a variable payment? Because it's not a fixed amount. The contract amount is a fixed payment. We know every single month they're going to pay 1,000 Rand per month. But the out-of-bundle services, that depends upon usage. So until we know the usage, then we will only know the amount. So that, from an IFRS 15 point of view, is a variable consideration. So a variable consideration does not form part of the total consideration of the transaction price. You account for that as and when it occurs. Okay, so just take note of that. So they're indirectly telling you that there could be a variable consideration. Okay, they say mobile prepaid customers need to purchase airtime, which they then use to make voice calls, send SMSs, and access data. These customers need to buy their own handsets. Okay, so here we have outstanding matters. The CFO of Cellular is in the process of analyzing the service revenue performance of the company for the 2016 financial year and is considering a number of financial reporting matters arising from its contracts. Okay, so here is where the stuff starts. So financial reporting matters. Cellular offers different types of cellular packages to serve the needs of its customers. The latest offerings are the following: pay now and then go, The pay now and then go option allows customers to purchase data, SMS messages, and voice minutes or bundles thereof separately for cash upfront without the commitment of a 24-month contract and the additional cost of financing a smartphone or tablet. The observable standalone selling prices of data, SMSs, and voice minutes are as follows. So here they're giving you the standalone selling prices. Remember, the best standalone selling prices is the observable standalone selling price. If you don't have an observable standalone selling price, you must work it out, estimate it. So in our cases, they most likely also give us an observable standalone selling price. Why is this important? We need it to allocate a transaction price. So we use standalone selling prices to allocate a transaction price to its separate performance obligations. Okay, so here you can see data can be bought separately, SMSs can be bought separately, voice minutes can be bought separately. So those are observable standalone selling prices. So most likely that is a separate performance obligation, that SMS is a separate performance obligation, voice minutes is a separate performance obligation because you can buy it separately. Now they're giving us two observable prices per unit, per bundle. Okay. When you want to use standalone selling price, you can use any one. Okay, it doesn't matter which one you want to use. But if you think of it practically, if a contract is 100 megs, you will use this one. Okay, but let's say the contract is 200 megs, then you will probably want to use the unit level. Okay, so but it doesn't matter which one you use, any one is fine. Okay, so they're giving us the observable standalone selling prices. Why do we need it? Because we want to allocate a transaction price. Okay, now we have a MyLife contract. So the MyLife 100 contract is an example of the MyLife contracts. So just think about, you have the MyLife 100, 200, 300, 400. You can imagine the type of contracts that the various companies have. Okay, so the MyLife 100 is an example of a MyLife contract. This contract offers 100 meg of data, 100 SMSs, and 100 voice minutes per month in return for a fixed monthly payment in advance. Take note of that. For the duration of a 24-month contract period. Okay. So here you can see it's per meg, per SMS. Here they're giving you per 100. You can use any one, but which one makes more sense in my mind is to use this one as your standalone selling price, the per bundle, because it's 100, 100, 100, 100, everything is 100. Okay, so just take note. But if you have used per unit, you have been totally fine. Okay, the solution will have answers for both. So the MyLife 100, this contract offers 100 meg of data. Okay, we read that. Okay, so there's a fixed monthly payment in advance for the duration of a 24-month contract, as well as an iPhone speed smartphone supplied to the customer once the contract has been concluded and signed. The fixed monthly fee is $5.89 per month. Okay, so let's just stop over there. So in a MyLife contract, you get data, SMSs, voice minutes, and a phone. So you're getting 4 things: data, SMSs, what's the other one? Voice, minutes, and a phone. Okay. Each month you get the data, the SMSs, the minutes, and upfront, you get the phone. So at the beginning of the 24-month contract, once you sign the contract, you get the phone. And then over the 24-month contract, each month you get the other items. Each month you have to pay $5.89 upfront. Okay, so that's important. So let's say you enter in the contract on 1 January. So on 1 January, you have to pay $5.89. On 1 January, you get your phone. Okay. Okay, and then On 1 January, and then on 1 February, you again pay 589. On 1 March, you again pay 589. So at the beginning of each month, you will pay 589. Every month, you will get your data, SMSs, and minutes. We need to just see when we get the data, SMS, and minutes. If it's also if it's also at the beginning of the month, and then at the phone we are getting at the we're getting upfront. Okay, why is this important? Because when we allocate the transaction price, we need to determine whether we need to discount the transaction price, because we need to identify whether there is a significant financing component. But we'll deal with that when we come to answering the question. Okay, so they say to enter into My Life contract, customers select a contract based on their requirements, complete an application form, and provide the required regulatory information. Okay, so it's FICA to Cellular. Cellular performs a credit check to assess the creditworthiness of the customer. This normally takes 25 minutes to complete and is done while the customer waits. Cellular makes use of a credit verification system offered by Credit Check. Once the credit check has been successfully completed, a sales representative explains the contract terms and conditions to a customer, who then signs the contract. Okay, this over here is a very nice for auditing. Okay, like I said, it's a psych exam, so it's probably one big question. So remember, an ITC exam is broken up into 4 exams. Each exam spread over 2 days. Day 1 you have 2 papers. Day 2 you have 2 papers. Each paper is 100 marks. Each paper generally split between 80 mark and a 20 mark, with 60 mark and a 40 mark. So each paper generally like 2 questions mostly, right? And then they will test you 2 subjects, either whatever you don't know which subjects. So most likely this could have been 100 mark question, okay? And they tested auditing as well as accounting. So the accounting part was most likely revenue, and then auditing was probably audit the revenue process. I'm just assuming, because this information over here is too detailed to take me through the whole process for accounting question. It's most likely used for the auditing part of the question. I'm just assuming, I'm not saying that was what happened. Okay. So here is the contract with the customer. The various steps they're taking you through, like just triggers to me. Here you need to audit the revenue process. They say the data, SMS, and voice minutes that form part of the My Life contract are priced at a discount of 15% to the equivalent standalone bundle selling prices applicable to the pay now and then go options. Okay, so here's very important. Okay, so here, this is very, very important over here. So in this contract, we from point number 2, My Life contracts, we already spoke about that the phone is given up front and you're going to pay over 24 months. The data and the SMSs and the voice minutes are given each month. So when you allocate the transaction price, you need to identify whether the transaction price is, whether the separate performance obligations of each transaction price is, have a financing component. Now, since you're paying monthly, and since data, SMS, and voice minutes are provided monthly, there wouldn't be a significant financing component. So what you must understand, a financing component would take place if you are providing financing for more than 12 months. So here you can see the phone is given up front, and the final amount is paid 24 months later. You're paying it over 24 months, but the last payment is made 24 months later, which is longer than 12 months. So that indicates a significant financing component. Whereas the data, SMS, and minutes, you pay monthly, you get the minutes monthly. It's less than a year. So it's happening every month. So therefore, the data, the minutes, and the SMSs won't have a financing component, but the phone will have a financing component because the phone is being paid over 24 months, whereas while the phone is provided upfront. So just take note of that. Okay, as you can see also, they made mention here somewhere under pay-as-you-go, under prepaid customers. Under prepaid customers, they made mention. Where did I see prepaid customers? Yeah, prepaid customers purchase airtime, which they then use to make voice calls and access data. These customers, I didn't see it there. Somewhere I saw it, where they spoke about they don't require financing. How will I find it again? Somewhere I read about it. Oh yeah. Yeah. So here they said to pay now customers separately for cash upfront without the commitment of a 24-month contract and the additional cost of financing a smartphone. So there you can see there is a financing component for the smartphone if you enter into a contract. Okay, so that is, you can also pick that up from there. Okay, so that's the first thing. Now here is the second item, a discount. So when you come with a discount, they are telling you that data, SMSs, and voice minutes that form part of a My Life contract are priced at a discount of 15%. It does not mean that they're telling you that there's a 15% discount, that we're actually going to allocate a 15% discount. Okay? So they're telling you that it's priced at a discount relative to the standalone selling prices. Despite them telling us that, it does not mean from an accounting perspective, we're going to actually allocate a discount. I'll explain to you when we come there, how do we determine whether there is a discount or not? On a very quick basis, when you work out the price, you need to work out the total standalone prices, and then you must compare it to the total contract price. If the total standalone prices is more than the total contract price, only then will there be a discount. If the total standalone selling prices is less than the contract price, then there won't be a discount. Okay, so just take note of that. Despite them telling you here is a discount, the fact you need to, the way you test for a discount is you compare the total standalone prices and you compare it to the total contract price. If the total standalone selling prices is more than the contract price, then there is a discount. If it's less than the contract price, then there is no discount. So if there is a discount, then we need to ask ourselves, how do we allocate the discount? The discount can be allocated in three ways. Number one, the most common way, it is allocated to all the separate performance obligations. Number two, actually there's only two ways, or no, there's three ways. So number one, it is allocated to all of the separate performance obligations. Number two, it is allocated only to one performance obligation and not to the others. And then number three, which is similar to number two, it is allocated to some of the performance obligations, but not all. So the first one is allocated to all the performance obligations. Number two, it's allocated only to one performance obligation and not the others. And number three, it is allocated to some of the performance obligations, but not all. So how do you pick up? So this paragraph will tell us. So here you can see they're telling you that data, SMSs, and voice minutes form part of a MALA or priced at a discount of 15%. So if there is a discount, then it would imply that the discount will be allocated only to these three items and not the phone. If they said the discount is allocated to all the items, then you will allocate it to all the items. If they say the discount is only allocated to the phone, then the full thing will be allocated to the phone only. So that's very important. So the first thing is to identify if there is a discount. And then if there is a discount, you need to ask yourself, to which performance obligations do I allocate the discount? If they tell you nothing, then it gets allocated to all the performance obligations. If they tell you, like in this case, they're specifically saying the data, SMS, and voice minutes have a discount, then you'll only allocate the discount to those 3 items. So just take note of that. Very, very important. Okay. But more important, it does not mean that they're telling you there's a discount, that we will actually account for a discount. We need to test whether we should account or not. Next. Next, data messages and voice minutes not used by a customer in a particular month are not carried forward to the next month and thus forfeited. Thank goodness for that. Others have been very complicated. Okay. In reality, that's not true. It lasts like for 3 months, I think, and then it gets forfeited. That's complicated. Okay. So if you don't use, you forfeit. Why is that the case? That indicates when you can recognize revenue. So we can already identify that data, SMSs, and voice minutes get supplied monthly, and you have to use it monthly. So the revenue will, for data, SMSs, and minutes will be recognized each month over over the 24-month period. But the phone will be recognized at a point in time. So the phone will be recognized at 31, at the beginning of the contract, okay? Because that's when we supply them with the phone. We have no further involvement with the phone. There's nothing more we need to do. We have given him the phone. There's nothing else we need to do. So, sorry, we have performed our obligation. Can I just go get some water? I'm back. Okay, so here they tell us iPhone SP is the latest smartphone in the iPhone I line of smartphones and incorporates a 3D, okay, all of those. The price of the iPhone I SP, if sold separately and not part of a contract, is 8,000 Rand. So there is the standalone selling price, okay? So just take note of that. Okay, so the last page, a 12-month warranty. A smartphone or tablet granted by Cellular to customers is covered by a 12-month warranty provided by Cellular. So a smartphone tablet granted by Cellular to customers is covered by a 12-month warranty provided by Cellular. If a faulty device returned within 7 days of purchase, the customer receives a new device as a replacement. If it is returned after 7 days, Cellular will repair the device at Cellular's expense. The warranty only covers manufacturing defects and excludes liquid contact damage and domestic damage such as scratches, dents, and broken screens or ports as required by the Consumer Protection Act. Defective devices returned after the 12-month warranty period are still repaired, but at the cost of the customer. Okay, so before we go into that over there, let's understand the following. So when it comes to a warranty, the question will have to, so you can see all contracts have a warranty, okay? Have a 12-month warranty. So a smartphone is covered, not contract, every smartphone or tablet has a 12-month warranty provided by Cellular. So when you see a warranty in a question, you need to ask yourself whether the warranty is a separate performance obligation or not. Now, when you read IFRS 15, IFRS 15 provides specific guidance as to whether a warranty is a separate performance obligation or not in the application guidance B. Okay, so if you have IFRS 15, the standard application guidance B, there's a section regarding warranties. But before we get into that, what you must understand that when you want to test for a separate performance obligation, you have to apply the general rule, which is a separate performance obligation. A promised goods or service would be a separate performance obligation if that promised good or service is distinct. Now, what makes the promised good or service distinct is if it can be used, if you can benefit from the goods or service separately on it or on its own, or with other readily available services, or not or, and it is the promised goods or service is distinct within the context of the contract. So it needs to meet both. So remember, whenever you want to identify a separate performance obligation, you need to apply those criteria. But over and above that, when it comes to warranty, the application guidance B, Appendix B, application guidance B, application guidance, which is Appendix B of IFRS 15, deals specifically with a warranty. How do you identify whether a warranty is a separate performance obligation or not? So the application guidance says that a warranty, there are different types of warranties in the world, right? There's so many, you can't account for all types of warranties, can't explain all types of warranties, but basically it comes down to two things. A warranty could either be that you only have a warranty in order to ensure that the good or service that you are providing, what's the word they use, like works in the condition as it's supposed to work. Okay, then there's a second type of warranty. So the first type is you provide the first type warranty is that you are just providing assurance that the promised good or service works as intended. And if it doesn't work as intended, you will make it work as, you will fix it up so that it works as intended. The second type of warranty is an assurance warranty, same like the first one, but also includes a service. So what does it mean? That so they give you guidance on how to identify whether it is an assurance with a service. But the easiest way to think through a warranty is to start off as follows. Number one, you ask yourself the question, can you purchase the warranty separately? If you can purchase the warranty separately, then it will be a separate performance obligation, okay? So if you can purchase the warranty separately, then it will be a separate performance obligation. So obviously the flip side is, if you can't purchase a warranty separately, then what? So if you can't purchase a warranty separately, then it will either be a separate performance obligation or it will not be a separate performance obligation. So the easy one is, if the warranty can be purchased separately, automatically it is a separate performance obligation. The tricky one is, if you can't purchase the warranty separately, then it is either a separate performance obligation or it is not a separate performance obligation. So it will not be a separate performance obligation if you're only providing assurance. Okay, what is assurance? You're assuring the customer that the item will operate as intended. If the goods or service does not operate as intended, you will fix it to a point that it operates as intended. Then it will be a separate performance obligation if the warranty provides assurance together with additional service. Okay, so IFRS 15 gives you 3 ways of identifying whether a warranty is only assurance or whether a warranty is assurance plus an additional service. So the first one is, I just want to share it with you, but I'll share it with you now. So the first one is, if the warranty is there only as a result of law. So the company only has a warranty because it is required by law, then it indicates that it is only an assurance warranty and it is not an assurance with an additional service. So that means it indicates that it is not a separate performance obligation. The second criteria is, if the warranty is for a long period of time, then it indicates that it is an additional service, and as a result, it will indicate that it is a separate performance obligation. So the first one, if it is only done according to law, you only have a warranty because it is required by law, then that means it indicates it is not a separate performance obligation. If the warranty is for a long period of time, now what is a long period of time? It's relative to the type of product you have. So let's assume that typically a product like this will have a 3-month warranty, a 3-year warranty, but you're only providing a 12-month warranty. And that indicates it is not long enough. So it is not a long period of time. But if it is a long period of time, then it does indicate that it is a separate performance obligation. So just take note of that. So when you have a warranty, what's the first question? Is the warranty sold separately? If the warranty is sold separately, it is a separate performance obligation. If the warranty is not sold separately, then it is either a separate performance obligation or it is not a separate performance obligation. It will not be a separate performance obligation if it's merely assurance, meaning you're only assuring the customer that the product operates as it should operate. And if it doesn't, you'll fix it up to a point that it does operate as it should. It will be a separate performance obligation if it's an assurance with an additional service. So just take note of that, okay? So if you have a warranty because it's required by law, so here they're telling you required by the Consumer Protection Act. So you can see that they're only doing manufacturing defects. They're not including other stuff because what is required by law? Only manufacturing defects. Okay, so you can see they're providing a contract, they're providing a warranty merely out of requirement by law. They're not providing a contract because they want to do something extra. Okay, for 12-month period, I don't know whether that is long or not. Okay, I don't know what is. They don't tell us whether it is long or not. Okay. And then I can't remember what's the third criteria. Let me just see if I can see the third criteria. Oh, the third criteria is the type of tasks that they do for the warranty. If the tasks that they are performing for the warranty, it is basically the minimal, that is basically what is required for them to perform, then it indicates that it's not a separate performance obligation. But if they're doing stuff that is beyond what is required, then it does indicate a separate performance obligation. Okay, so here they're telling you Every smartphone has its own serial number. Cellular systems link the serial number to the warranty, the date of purchase, and the customer's details. Customers do not have the option of purchasing a warranty separately. Okay, so here they're telling us because they don't purchase a warranty separately, it means that the first one is that it's not a separate performance obligation. So we need to test for the other one. Okay, so remember, if they can purchase a warranty separately, automatically it will be a separate performance obligation. Now, this option is they can't purchase a separate performance obligation. So that means it's either a separate performance obligation or it is not a separate performance obligation. For it not to be a separate performance obligation, they merely provide assurance, okay, that that the item operates as it should operate. It will be a separate performance obligation if they provide assurance together with, together with an additional service. Now, so the three things, if they're doing it because it's required by law, then it indicates only assurance and not an additional service, meaning it will be not a separate performance obligation. If the length of the warranty is not long, it is short, then once again it is only it implies they're merely doing assurance and not additional service. So it implies it is not a separate performance obligation. Or if the tasks that they are performing within the warranty contract agreement, it is just the minimal requirements to make sure that the promised good or service operate as intended, then it also indicates that it's only assurance and not additional, and as a result it will not be a separate performance obligation. So here you can see they're only doing manufacturing defects. They're not doing any of these other additional stuff. If they do of these other additional stuff, it will indicate as additional service. But because they're not doing these additional things, it is not additional service. So they're only doing what is required. The task that they are doing is only doing what they are required. Okay. Then they're telling you that, and it's also only required by the Consumer Protection Act. They're only doing what is required within what is required by law. So it indicates they're only providing assurance and not an additional service. So as a result, the warranty will not be a separate performance obligation. That's from a warranty perspective, but you must still discuss it from a separate performance obligation perspective. Remember, in order for an item to be a separate performance obligation, it needs to be distinct. In order for an item to be distinct, or in order for a promised good or service to be distinct, it must be able to be, you must be able to benefit from it separately. Now, you can't benefit from this you can't benefit from this thing separately because you can't purchase it separately. Okay, if you could purchase it separately, it would be a separate it would indicate that you can benefit from it separately. The second thing is that the warranty must be provided within the context, is provided as a distinct item within the context of a contract. So as you can see, you only get a warranty if you have a smartphone. They have a sophisticated system that link the serial number to the warranty. Without this, you can't benefit from the warranty. So as you can see, the warranty is not distinct within the context of the contract. The warranty is, you only get the warranty as a result of purchasing the phone. So therefore, the warranty is not distinct within the context of a contract because you only get the warranty as a result of purchasing the phone. So that indicates that this is not a distinct item, and as a result, it is not a separate performance obligation. Okay, so just take note of that. So it is a bit complex, but that is basically what you need to be able to identify. Okay, so here they say cellular management of the following reliable estimates in respect of warranties. Smartphone offered in terms of my life contracts are returned for repairs as follows. 0% is returned for exchange during the first week after signing the contract. 28% are returned for repairs during the 12 months following the sale. 25% of those repairs are a result of liquid contact or cosmetic damage. Okay, so as you can see, basically only 3% is for manufacturing defect. 15% are returned for repairs after the 12-month warranty period. So remember, in the first 7 days, there's an actual exchange of a phone. Okay, in the first 7 days, there's an actual exchange. So they'll take the phone and give them a new phone. In the 12-month period, they will repair the phone at their cost, but they will only repair the phone at their cost if it is a manufacturing defect. If it is any other defect, they will not repair. Okay, and then the 15% after the 12 months, they will repair it, but at the cost of the customer. Okay, so just take note of that. So then the probable cost per smartphone that Cellular will incur to repair a smartphone covered by the 12-month warranty is as follows. 60% probability that Cellular will incur an average cost of 4,800, 40% probability that it will incur an average cost of 6,700. So how you work this out, you would say 4,800 times 60% plus 6,700 times 40%. You add the two numbers together, and that will be the average cost for a repair. Okay, so just take note of that. But remember, they'll only repair 3% because this they don't incur the cost over here. And although 28% is returned within the 12-month warranty period, they only repair manufacturing defects. Other 28%, 25% is as a result of liquid contact or cosmetic damage, which they don't repair. Okay, so yeah, they're telling you the warranty only covers manufacturing defects, exclude cosmetic defects. Okay, so just take note of that. Okay, so here we have computer data. We come back to this. Let's just quickly finish. Have a look at whatever we have over here. An appropriate discount rate in a suite of contracts is 9%, compounded monthly where required. So remember we spoke about the financing component. We have to apply the 9% to discount. Cellular has a 31 October year in, early adopted IFRS 9. Not apply the portfolio approach as defined in paragraph 4 of IFRS 15. All contracts are within the scope of IFRS 15. A portfolio approach is basically you just lump similar contracts together. Most people will apply in reality, they most likely apply the portfolio approach because that is much easier. They can't go through every individual contract. But over here, we're basically going through every individual contract and we apply IFRS 15 to every individual contract. For example, the financial services like Old Mutual, Sanlam, they have a lot of contracts. So they will lump similar contracts together and they will review only a few. And then based on the few that they review, they'll come up with a policy. And then every contract that is similar will fall into that particular policy because they have no time and capacity to review every single individual contract. Okay. So I'm just going to discuss this as we talk through it. And then I want to focus on the 23 marker. Okay. So here they say, discuss the following with regard to the My Life 100 contract in terms of IFRS 15. So there's a nice detailed solution in this solution that you can read through. But I was going to give you some important points. If you require further detail, you can contact me. Okay. So here they say, whether the 12-month warranty offered on the phone should be identified as a separate performance obligation. Do not discuss the 7-day returns policy. Okay. So is it a separate performance obligation? When you see separate performance obligation, you apply the general rule of separate performance obligation. I'm just calling it a general rule. It's not called the general rule. I'm just saying general rule. Okay. So remember, for a promised good or service to be a separate performance obligation, that promised good or service needs to be distinct. In order for that promised good or service to be distinct, it needs to meet two criteria. It must meet both. That the promised good or service can benefit from the promised good or service on its own or with other readily available services. Number two, the promised goods or services the promised goods or services transferred is distinct within the context of the contract. Now, for criteria number one to be met, an example of being able to benefit from a goods or service separately means you can buy it separately. The fact that you can't buy the good or service separately implies that you can't benefit it on its own. Okay. In order to benefit from the warranty, you need to take out the phone. Okay. So that indicates that you can't benefit from it on its own. Is it distinct within the context of the contract? The answer is no. Why? Because why is it not distinct within the context of the contract? The fact that you can't buy the warranty separately, and that you can only benefit from the warranty. The only way you can benefit from the warranty is by buying the phone, because by buying the phone, only that gives you a right or gives you access to the warranty. And you can see that the phone, the serial number of the phone is linked to the warranty. So that shows you that the only way to benefit from the warranty is to take out the phone. So as a result, in the context of the contract, the warranty is not distinct. The warranty has to be bundled with the phone. So as a result, it does not meet the distinct criteria. So because the warranty is not distinct, it is not a separate performance obligation. Can I give you a nice explanation? You can go through all the details over there. And then over and above that, you can talk about the specific guidance in the application guidance of IFRS 15 that deals with a warranty. So the application guidance says that that if a warranty can be purchased separately, it will be a separate performance obligation. If a warranty cannot be purchased separately, it will either be a separate performance obligation or it will not be a separate performance obligation. In order for it to be a separate performance obligation, the warranty must provide assurance together with additional services. If it only provides assurance, it will not be a separate obligation. But if it provides assurance together with additional services, then it will only be a separate performance obligation. So how do you know if it's assurance with additional service? So I'll give you some guidance. I said, if the warranty is only as a result of law, then it implies it's only assurance and not additional service. If the warranty is not long in nature, the period of the warranty is not long in nature relative to other warranties in the same category, then it is it indicates to only assurance and not additional service. If the tasks performed within the warranty is the minimal tasks, there's no additional task being performed, then it also indicates only assurance and not additional services. So in this one, the warranty is provided only as a result of the Consumer Protection Act. They only provide the minimal tasks, which means only repair defective manufacturing defects. They don't do any other stuff like liquid damage, this damage, and that damage. So as a result, you can see the task performed is minimal. The warranty is provided as a result of the Consumer Protection Act, which is law. So that indicates that it's only assurance and not additional services. So it's only assurance and it's not assurance with additional services. As a result, it means that the warranty is not a separate performance obligation. Okay, so that is for part A1. Okay, so for part A2, whether a significant financing component exists for the performance obligation in a My Life 100 contract. So here we can see the performance obligations. So we have the phone. We already discussed this as we went through the scenario, but we have the phone and then we have the, what's the other one now? So we have the phone, and we have the, what did I say now? So we have the phone, and then we have the data, messages, and what's the other one? And SMSs, okay? The data, SMSs, and minutes. So it's a 24-month contract. So there's a monthly payment. So each month we pay $5.89. Each month when we pay $5.89, we get the minutes, the data, and the SMSs. Because each month we get that. So since the data, the SMSs, and the minutes is provided monthly, and there is a monthly payment, that means there is no significant financing component for that. When it comes to the phone is provided upfront, whereas the payment happens over a 24-month period. The final payment is only happening at the end of 24 months. So as a result, the phone is provided upfront. Payment is happening over a 24-month period, which is longer. So IFRS 15 has a practical expedient, which means that if the payment happens 1 year or less, 12 months or less after the service is provided or the good is provided, then there will not be a financing component. But if it's beyond 12 months, then there is a financing component. So here you can see the phone is provided up front, the payment is happening over 24 months. So that indicates that there is a significant financing component. Also, what do we know? That the practical expedient cannot be applied because the period is longer than 12 months. You can only apply the practical expedient if it is 12 months or less. So that indicates that for the phone, there is a significant financing component, and as a result, we're going to have to discount the transaction price that is allocated to the phone. Okay, so that's basically your 6 marks over there. So now they're telling us the allocation of a transaction price to the separate performance obligations in the MyLife contract. Assume that the phone, data, SMS, and voice minutes are each separate performance obligations. Ignore the 12-month warranty. Okay, so you can discuss the allocation of a transaction price. So what I'm going to do, because I'm going to work out the thing over here, I'm going to work out this over here, then I'll show you how we can do, then you can try to attempt the allocation of a transaction price of A3. Okay, so let's look at part B. If we have some time, we'll do part A3, but part B, I'm going to do part B, but doing part B, we will be able to do part A3 as well. So they say prepare the journal entries to be processed in December 2016 for Cellular Connect Ltd to account for all the consequences arising from the 100 computer and data contracts sold on 1 December 2016. Assume there are only 2 distinct performance obligations in the contract, namely the computer and the 3 gigabytes of mobile data. The cost of the SIM card is negligible and can be ignored. Okay, so there you can see that. Let's just go read that contract part this over here. So computer data and contracts. Cellular introduced a new type of contract in the 2017 financial year, which bundles a computer, SIM card, and 3 gigabytes of monthly mobile data at a special promotional price of $3.49 per month over a 24-month period, payable monthly in arrears. Okay, so take note. In the other example, it was monthly in advance. Over here, it's monthly in arrears. There is no upfront connection fee. The standalone selling price of a mobile computer is 5,000 Rand, and the 3 gigabytes of mobile data are provided at the beginning of each month and can be rolled over to the following month. Oh, yeah, they have that, okay? At the end of which the unused data will expire. So take note, we're going to pay 349 at the end of each month. Okay, at the beginning of each month, we get data. Any unused any unused of those items of the data and all any unused data will roll over to the next month. So basically, data is provided for 2 months. Okay, so each month's data is provided for 2 months, and thereafter it will expire. Okay. Okay, the standalone selling price of a 3 gig mobile data bundle is 180 per month. Extra mobile data is charged at normal out of bundle rates as and when used. Okay, so that is the variable component. When we determine the transaction price, we don't worry too much about them. The variable component will be recognized as revenue as and when it arises. Okay. The contract also stipulates a returns policy. Okay, so remember, when we have a right of return, when we recognize revenue, we have to allocate a portion for a right of return. The contract can be cancelled without penalty within 7 days of signature, provided that no data on the contract has been used. It is expected that on average, 3% of computers will be returned under the returns policy. Okay, the following a successful credit application, the computer is given to the customer and the SIM card and data are activated. Cellular sold 100 contracts on 1 December 2016. Okay, so let's take note. So on 1 December 2016, 100 contracts were sold. So on 1 December 2016, 100 computers were provided and 100 3 gig datas were activated. Okay. The payment will only happen at 30. The first payment will only happen on 31 December 2016. So the data is provided monthly and a payment is made monthly. So there's no significant financing component between the data and the payment. Okay. However, the cell phone is provided up front, whereas, the computer is provided up front, whereas the payment happens over a 24-month period. As a result, there is a significant financing component. Okay, so just take note of that. Okay, so of the 100 sold, one customer canceled the contract in terms of the returns policy. With regard to the remaining 99 contracts, actual information shows that 75% of the data was used in the first month and the rest was carried forward to the next month. Cellular purchased the computers for 3,500 Rand each in November 2016. Okay, so we account for 3%. 3% of 100 computers is 3. So the right of return would account for 3 returns. What actually happened was only 1 return. So let's deal with this by being able to allocate the transaction price over here. You can replicate it and attempt to allocate a transaction price for A3. So you can attempt A3 using what we're going to do in part B, and then you should be fine. Okay. And if you have a problem, you can just contact me. So I'm going to stop sharing. So I want to share Google Sheets, and then we're going to answer part B. What do I want to do? Sorry, just wait for my audio to open up quickly. Okay, so remember, what do we need to do? We need to prepare the journal entries to be processed in December 2016 to account for all consequences arising from 1 October from the 100 computer and data contracts sold on 1 December 2016. Assume there are only two distinct performance obligations in the contract, namely the computer and 3 gig of mobile data. The cost of the SIM card is negligible and can be ignored. Okay, so now we need to recognize, we need to account for all transactions in December 2016. So the way to think about this is to read the scenario and identify all the events that took place in December 2016. To identify all the events that took place in December 2016. Once you identified the events, then you ask yourself the question, is there an accounting consequence? Is there an accounting transaction? If there is an accounting consequence, if there is an accounting transaction, then we have to recognize a journal. Sometimes an event takes place, but there is no accounting consequence. So that is why I first identify the events, like dates. So identify the different dates that something happened on, and then ask yourself, is there an accounting consequence? Like I said, in many instances, events takes place, but there's no accounting consequence, and as a result, no journal entries. But if there is an accounting consequence, only then will there be journal entries. So basically, there are 3 dates, events that happen. Number one, on 1 December 2016, we signed a contract. The virtue of signing a contract does not necessarily mean anything. So the virtue of signing a contract, just give me a moment. Okay, so on 1 December, an event took place, contracts got signed. A signing of a contract on its own does not mean anything from an accounting perspective. But on that date, when we signed contracts, there were certain additional things that happened. We provided a computer, we activated the data, and we provided the SIM cards. Okay, now we know the SIM cards is negligible, so we can ignore. But the providing of the data and the providing of the computer, we know are separate performance obligations. So we need to ask ourselves, are there any journal entries on 1 December 2016 for those 2 separate performance obligations? Now we know to recognize revenue, to recognize a performance obligation, which is revenue, is one of 2 things, either at a point in time or over a period of time. For the data, we still have to provide a service over the month. We provided the data we activated the data on 1 December, but we need to supply that data for at least December and at most December and January. So on 1 December 2016, we have not provided the obligation for that distinct good or service. So we can't recognize anything for the data, because we have to provide the service over the period of the 2 months or at least the 1 month. On the other hand, for the phone, once we have given the phone over to the customer, once we have given the computer over to the customer, there's no further obligation on our side. We have done, we have performed based on the promise in the contract, we're only providing you with a computer. So once we have given them the computer, we can recognize revenue at that point in time. So therefore, on 1 December 2016, we can recognize the revenue of the computer, because once we handed over the computer, our performance obligation has been satisfied. There's no further involvement from us with respect to the computer. That's very, very different for the data. On 1 December 2016, we did activate the data. However, we still have to satisfy that performance by having the data activated for the remaining of the month, and perhaps even the second month. So therefore, on 1 December 2016, we can't recognize revenue for any data because the customer haven't yet used the data. We still have to provide them the use of the data. So we can only recognize revenue on 1 December 2016 for the computer. Now comes the second part. So we know when to recognize. Now we need to know at what amount. So that is where step 2 comes in, when we determine the transaction price and allocate the transaction price. So I'm going to do it for this one. Then you can do it for A3 because it's a similar thought process. There's just slightly more performance obligations involved. Then over and above that, when we have something where we have a right of return, we also need to account for the right of return of that phone, of that computer. So on 1 December 2016, when we want to recognize revenue, at that very date, when we recognize the revenue for the computer, we also need to recognize a right of return. Okay, so on the exact same date, we recognize revenue and the right of return. The purpose of this is that revenue needs to be recognized based on a consideration that you expect to be entitled to. So revenue should be recognized based on a consideration that you expect to be entitled to. So yes, you have sold 100 computers, but based on your past experience, you know 3% of sales gets returned. So by you selling 100 computers, 3%, which is 3 computers, you expect to be returned. So all that 100 computer sales, you expect to be entitled to only 97. So as a result, we will recognize revenue for 97 computers and recognize a right of return or a refund liability of 3. Okay, so just take note of that. So let's switch over into Google Sheets again. Okay. So I'm going to quickly close the other files. Okay. So let's have a look. Okay. So 1 December 2016. Okay. So we have debit and credit. So 1 December 2016, we're going to recognize a debtor. Okay, so we're going to say contract debtor. We're going to have revenue. So we'll remember, we can't recognize bank. Remember, when you make a sale, you'll generally say debit bank, credit revenue. But we can't debit bank because no cash flow happened on 1 December 2016. So as a result, it can only be a debtor. So we'll call it contract debtor. This is SFP. This is P&L. But now we also know that there is a there is a right of return. So then we also have a refund liability. Okay. Then with every sale, there's cost of sales. So then we will say debit cost of sales. Debit cost of sales, P&L. We're going to say credit inventory. So for every sale, when you have a sale, we say debit cost of sales, credit inventory, SFP. But as we have a right of a refund liability, we will also have a right of return asset. Okay, so if they want the money back or they want to owe us anything, they need to return the item. So this will be a SFP. Okay, so just take note of that. Now we can work out the numbers. Now we can work out the numbers. So I'm going to have my workings over here. So for working one, we want to work out the transaction price. All we're going to do is, I'm going to have here details. We list, this is basically the performance obligations. Okay, these are the performance obligations. So the performance obligations is the computer and the 3 GB data. Okay, the standalone selling price, remember, must be total standalone selling price. So what is the standalone selling price? The standalone selling price for the computer was 5,000 Rand. So if you buy it separately, it'll be 5,000 Rand. The standalone selling price for the data is 180 Rand per month. We know this is a 24-month contract, so we multiply by 24. So therefore, the total price is going to be, so the total standalone selling prices is going to be 3920. Okay. So now we can allocate the 3920. Actually, I want to just change this quickly. So I'm going to determine the transaction price first. Okay, so the transaction price would just be basically monthly payment, number of months, and it will be total transaction price. Okay, so the total transaction price would be the sum of those, or the whatever we call it. Okay, so the monthly payment, 349. The number of months, 24 months. So the transaction price is that multiplied by that. So the transaction price is 8376. Okay, so 8376. Let me just do it like that. Now we have the standalone selling price. And now we can allocate the transaction price. So how do we allocate the transaction price? We do a weighting. So it is computer divided by the total standalone selling price multiplied by the total transaction price. Okay, then we're going to say the data divided by the total standalone selling price multiplied by the total transaction price. Okay, so that's what we have over there. Okay, now we ask, is the financing? So significant financing. Just ask yourself the question. So for the data, we already said there's no significant financing. Why is there no significant financing? Because data is received monthly, the payment happens monthly. For the computer, yes, there is a significant financing. Why? The computer was provided upfront on 1 December 2016, but we are paying monthly over a period of 24 months, right? So we're paying monthly over a period of 24 months. So there is a significant financing component. You cannot use the practical expedient, because the financing is for longer than 12 months. The practical expedient can be used if it's 12 months or less. Okay, so now we need to work out. Allocation of TP after financing. Okay. Okay, so that's what we want to do. Okay. So we know there is financing. So because there is no financing for this one, the amount will remain the same. Okay, so because there's no financing for that one, the amount will remain the same. We just now need to work out what is the financing for the computer. So just take note of that. So is there significant financing? Yes or no? If there's no financing, the original allocation will equal the final allocation. But for this one, there's going to be a change. So let's work out the financing component. So we simply use our financial calculator. What are we trying to work out? We're trying to work out the present value. Because there's a significant financing payment, we want to present value all the future payments to its present value. So the present value is what we want. In order to calculate the present value, we will need the future value, we will need PMT, we will need N, and we will need I. I was already given to us at 9% per month, 9% compounded per month. Okay, so okay, so it's going to be 9% equal 9% divided by 12. Okay, so we put it into 12. The number of compounding periods is 24. Okay, so the number of compounding periods is 24. The reason why I divided this by 12, because it's the percentage is annually. I need to get it into a monthly. I need to get into a monthly percentage. So I took the annual percentage and I divided it by 12. Okay. Okay, and the number of payments is 24 compounding periods, which is a monthly compounding period. The length of the period is 24. The payment needs to be a monthly amount, which is 349. FV is the future value. The future value is a lump sum payment at the end of the 24-month contracts. We know there's no lump sum payment. So now we can work out the present value. Okay, so the present value would be as follows. EV, open brackets, they will want I first, then they will want N, I think PMT, then that. Let's just see. Yeah, okay, so there we go. So the present value of the transaction price would be 7639. Okay, so the present value would be 7639. So that's the present value of the transaction price. Now we just allocate that to the we're just going to allocate the present value. So to allocate, we use the same allocation basis. So for the computer, and then for, we don't need to do the 3 gig data, but I'm just going to do it for completeness purposes. So we're going to say 5,000 divided by that, multiplied by that. I just want to make it positive. Okay. If there was a financing component, it would be that divided by that multiplied by. Okay, so if there was going to be a financing component, it would have been that, but we're not going to use that because there's no financing component. So take note, when you allocate, we're always using the standalone selling prices. And if there's no financing component, we allocate based on the total transaction price. If there is a financing component, only for the one that has a financing component, we still use the standalone selling prices as a weighting, and then we use the discounted transaction price. So just take note of that. So as you can see over here, that is based on the transaction, the discounted selling price. And why we're using the discounted transaction price? Why? Because there is a significant financing component. So we use that amount. This one has no significant financing. So therefore we used the normal transaction price, the undiscounted transaction price. Okay, so just take note of that. Okay, so with that information, we can now use our amount. I just want to get the monthly amount over here. So just for you to know over there, let me just do it over here. So the monthly revenue of data, total data revenue is the 382. Okay. If we divide that by 24 months, number of months, 24. So the monthly revenue data revenue is just simply going to be 388 divided by 24 months. Okay, so just be aware of that. Okay, so now we have the numbers, and now we can go and do our calculation. So we sold 100 computers. Okay, so therefore people owe us for 100 computers. How much do they owe us? So it's going to be the discounted selling price multiplied by, so we're going to take the transaction price 4098. So it's going to be 4098 multiplied by 100. Okay, so we're going to say 4098 times 100. Okay, so that is what they owe us. Now we need to recognize revenue. Now we need to recognize revenue. Okay, so revenue will also be based on the 4098. But now remember, we sold 100. But remember, if there was no refund, like if there's no right of return, if there's no returns policy, we recognize 100. But because there's a returns policy, we need to recognize revenue net of the returns. So 3% returns, so therefore 97% is what is expected that we are entitled, that we expect to be entitled to. So 4098 times 100 times 97%. In the refund liability, it's going to be the same as this. Okay, not like that. But with 3%. Okay, so then we're going to say equal 4098 multiplied by 100 times 3%. Okay, and we should balance. I'm just going to see if we balance quickly. You don't have to have this balancing thing in, but you must know at the CTA level, a journal entry will only be marked if it balances. If a third year and CTA level, if the journal entry don't balance, you get 0 for the entire journal entry, even if some of it is right. Almost. Okay, so it balances. Remember, if it doesn't balance, just make up another journal entry and make it balance, because otherwise you lose marks for everything if it doesn't balance. Okay. Now we have cost of sales. Now remember, when we gave the computers, 100 computers left our business. So therefore, what happened to inventory? 100 computers left inventory. I think if I remember correctly, each computer was 3,500. So 3,500 times 100. So 100 computers left our business. So therefore, inventory decreased by 100. Inventory is an asset. Inventory is decreasing. Assets is decreasing. Assets decrease on the credit side. So 3,500 times 100. Okay. Now, cost of sales can only recognize same as the revenue. Okay. So therefore, for cost of sales, it will be the same, and for the right of the asset will be the same as the refund liability. So for cost of sales, we sold 100, but we only expect 97 to actually turn out to be sales. So therefore, cost of sales will be 3,500 times 100 times 97%. Similarly, the right of return, we sold 100, but we expect 3% to be returned. So that is what it will be. Okay, so I'll just do the same over here. My journal should balance. Okay, so there we go. So that happens on 1 December. So that's what's happening on 1 December 2010. Whatever, 1 December 2016. Okay, now the next set of journal entries is going to happen on 7 December. That is 1 week later. 1 week later, the returns policy falls away. Okay, 1 week later, the returns policy falls away. So on 1 December, the returns policy falls away. So now we no longer have a refund liability, and we no longer have a right of return asset, because no one can return thereafter. But we have to account for the one that actually did return. Okay. So remember, for the one that actually did return, is already accounted for over here. It is already accounted for over here. So what we're going to do is as follows. We accounted for 3 returns, right? But how many actually returned? Only 1. But after 7 days, we no longer have a refund liability. After 7 days, we no longer have a refund liability. So we need to de-recognize, get rid of the refund liability. A refund liability is a liability. A refund liability is decreasing, therefore liabilities must decrease. A liability decreases on the debit side. So we're going to have a refund liability, and the full amount will be debited. Okay, so the full amount will be debited because we no longer require it. Okay, it's no longer there. Now the question is, how do we deal with this refund liability? So one person returned the computer. So therefore, one person no longer owes us money. So therefore, for the contract debtor, this person no longer owes us anything. So we must decrease contract debtors. Contract debtors is an asset. So contract debtors is decreasing, therefore an asset is decreasing. An asset decreases on the credit side. One person returned, so we decrease contract debtors for one person only. Okay, so we accounted for 3 returns, but only 1 return happened. Therefore, the other 2 returns is no longer actually returns. So therefore, they may be recognized as revenue. So they may be recognized as revenue because we're not going to return anymore. Then we have, and then we do the same thing. One person did returned. Okay, so okay, let's start with this one. So the right of return asset. So the right of return asset is no longer a right of return asset because the 7 days has lapsed. So therefore, we can get rid of the right of returns asset. Okay, so right of return asset is an asset. So right of return asset is decreasing, therefore assets must decrease, assets decrease on the credit side. The full thing will decrease because we no longer have a need for the right of return. Because the 7 days has lapsed, so there's no longer that no one can return. Okay. Within the 7 days, one person actually returned. So therefore, when they came at the return, they returned back the computer. The computer is inventory to us because it's sold in a normal course of business. So that is our inventory. So when they returned computers, computers increase. Computers is inventory, inventory is increasing. Inventory is an asset, assets increasing. Assets increase on the debit side. So we'll increase it by 1. Okay, so we accounted for 3 returns, but only 1 return happened. We accounted for 3 returns, but only 1 return happens. So what happens with the other 2 estimated returns? Because other 2 estimated returns didn't actually happen, they can be correctly recognized as revenue. Because we're recognizing revenue, we must also recognize cost of sales. So it will be 3,500 times 2. You can see the journal entry balances. Okay, now that is done. We did 1 December, we did 7 December. Now we can deal with 31 December. So on 31 is we have accounted for everything regarding the phone. On 31 December, we can only now account for the data. Okay. So on 31 December 2016, that is when we receive money. So on 31 December 2016, we're receiving money. So money is cash, cash is bank, bank is increasing, bank is an asset, assets increasing, assets increase on the debit side. So we say debit bank. Now remember, one person returned, so they're not going to pay us. So we have 99 customers times 349. That's what we're going to receive. So we're going to say equal 99 times 349. Okay, that is the cash that we are receiving. Okay. Okay, now we can recognize revenue for the data. Okay, now remember data. If all the data is, it was used in the month, we can recognize revenue for the full month for the data. Or if the data forfeits after the 1 month, we can also recognize revenue for the full month. But because data is spent, it can last you 2 months, we must only recognize data to the extent that it was used. So the December data can be used in December and January. So the December data can only be recognized in December to the extent that it has been used. They told us the December data has been used 75%. Okay, so just take note of that. So therefore, we're going to have revenue for data. And then, now remember, part of this amount is for the full revenue, is for the full 100% of data of December. Because part of this 349 represents 100% of the data. So we received money for 100% of the data in December. But we only provided data of 75%. The other 25% we still have to fulfill in the next month. So because they gave us money for 100%, the revenue will account for 75%. The other 25% must be recognized as income received in advance. Okay, so just take note of that. So this here is SFP. This there is P&L, and this there is a liability, so it is SFP. So how do we account for this? There's 99 contracts. And each month's revenue is 161. We did the monthly calculation above. But 161 represents the full month of revenue. We only satisfied the obligation to 75%. The other 25% is going to be satisfied next month. So we have to recognize, so we still owe that, we still have to satisfy that obligation, and we're only going to satisfy that obligation next month. So that will be 25%. So let's work it out. So revenue is going to be 99 contracts multiplied by 161. Remember, 161 represents 100% of the monthly data. But we never provided 100% of the monthly data. We only provided 75% because customers only use 75% of the December data. The other 25% they can use next month. So then it will be 99 multiplied by the monthly revenue amount times 25%. So now, if we add this up, you can see the journal entry is not balancing. The reason journal entry is not balancing is because of the reason why the journal entry is not balancing is because of that 349 is partly data and is partly phone. So the difference will go to the phone. Now remember, the difference of the phone is sitting under contract data. So as the months get paid, the contract data will decrease, because that represents the amount that is being paid for the phone. Okay, obviously just a slight rounding, so that's fine. And then lastly, we need to account for interest income, the financing component. So we need to account for interest income. Okay. So it will be, so we're going to recognize interest income. So we're going to recognize interest income, which is P&L. Interest income is an income. Income is increasing. Income increases equity. Equity increases on the credit side. So when we work it out, each contract, each debtor is 4098. There are 99 debtors, and we multiplied by the 9%. But remember, 9% is for the full year. So we're only dealing with December. So we multiplied by 1/12. So we will just go take that debtor amount, 4098, but there's 99 debtors. The discount rate is 9%, but that's an annual number. We're only dealing with December, so we say 1 divided by 12. And then we take it against I think I'm not 100% certain. I'll check just now. I think it goes against contract data. Okay, so that is basically the journal entries for all the events. So what I want you to do is to work through it yourself, and then if you have a question, you can ask me. And then the same thought process that I did over here is what you will do for for question A, point 3. Okay, so that's all from my side. Is there any questions your side? I'll upload this soon. Okay, as soon as it's done, I'll upload it. Is there any questions your side? I lost the question. No questions? There's no questions, guys. You guys are good to go. But basically, the key issues is performance obligation, identifying performance obligations, determining the transaction price, allocating the transaction price, and allocating the transaction price, and recognizing revenue. Then you must be able to handle a significant financing component, you must be able to handle a discount, you must be able to handle a warranty, you must be able to handle a right of return. Cindy Siwe, you can ask your question. Okay, not happen over there. Okay, guys, I need to jump off. If there's no other questions, then we are good to go. So I'll stop the session now. Okay, I hope you enjoyed it. I hope you found it beneficial, and I hope you learned quite a bit. I'll upload shortly, and please go through A3, and then see if you can deal with with part B that we covered. See you. Bye bye.